Hey everyone, and welcome back to the channel. Today, we're cutting straight to the chase and talking about something that can either make you a lot of money or cost you a fortune: stock market investing. For the next few minutes, I need your full attention because we're diving deep into the 7 keys you absolutely must know before you even think about buying a single stock. No fluff, just facts. First, and most importantly, investing is not gambling. The wrong way to invest is to throw money at a hot stock you heard about from a friend, hoping it'll double overnight. That's a lottery ticket, not an investment strategy. The right way is to do your homework. This means understanding the company's business model, its financial health, and its position in the market. You're not just buying a ticker symbol, you're buying a piece of a real business. Second, you need a clear strategy. Are you a long-term investor looking for steady growth, or a short-term trader trying to profit from market swings? Trading, or short-term buying and selling, is incredibly risky and requires a deep understanding of technical analysis and market sentiment. It's a full-time job for many. Long-term investing, on the other hand, is about buying solid companies and holding them for years, letting compound interest work its magic. For most beginners, long-term is the safer and often more profitable path. Third, understand risk tolerance. How would you feel if your portfolio dropped 20% in a week? If the thought makes you sick, you might have a low risk tolerance. That's okay. It just means you should focus on more stable, established companies, often called blue chip stocks, instead of volatile tech startups. Be honest with yourself about this. Don't chase high returns if you can't stomach the high risk that comes with them. Now, let's get into the nitty-gritty of what to expect. The stock market is volatile. It goes up and it goes down. Even the best companies will see their stock prices fall during a market downturn. The key is not to panic. Emotional decisions are the enemy of good investing. Selling everything when the market dips is how you lock in losses. The smart investor often sees these dips as buying opportunities. So, let's recap those first 3 keys. Invest, don't gamble. Have a clear strategy, and know your risk tolerance. Getting these right is 90% of the battle. Moving on to key number 4, diversification. Never put all your eggs in one basket. Spreading your money across different companies, industries, and even different types of assets is crucial. If one sector, like tech, takes a hit, your investments in healthcare or consumer goods might help balance out the losses. A great way for beginners to diversify instantly is through ETFs, or exchange-traded funds. An ETF like one that tracks the S&P 500 lets you own a tiny piece of 500 of the largest US companies with a single purchase. Key number 5 is to start small. You don't need thousands of dollars to begin. With fractional shares, you can start investing with as little as a few dollars. The goal is to get started, learn the process, and build good habits. The wrong way is to dump your life savings into the market on day 1. Start with an amount you're comfortable losing, and gradually increase your investment as your knowledge and confidence grow. Sixth, keep learning. The market is always changing. The best investors are lifelong learners. Read books, follow reputable financial news sources, listen to podcasts, but always be critical. Be wary of gurus promising guaranteed returns. There's no such thing. Your financial education is your best asset. And finally, our 7th key, have a long-term perspective. The most successful investors, think Warren Buffett, don't obsess over daily price movements. They focus on the 10-year, 20-year horizon. The market has historically always recovered from crashes and gone on to new highs. Patience is more than a virtue in investing. It's a requirement for success. Don't get shaken out by short-term noise. So there you have it, the 7 essential keys to investing. Understand the business, have a strategy. A. Know your risk, diversify, start small, keep learning, and think long-term. If you follow these principles, you'll be well on your way to building wealth responsibly and avoiding the common pitfalls that trap so many new investors. It's a marathon, not a sprint. Thanks so much for watching. If you found this helpful, hit that like button and consider subscribing for more no-nonsense financial content. Let me know your thoughts in the comments below. See you next time.